Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. And there's green on the screen this Wednesday morning ahead of a market holiday tomorrow. The Nifty's climbed above 17,000. It's up close to about 0.4%. Mid-caps are finally outperforming. So after a couple of days of serious underperformance and a sharp sell-off, the mid-cap index today is up close to about 0.9%, with the advanced decline ratio firmly in favor of the gaining side. 3 stocks in the green for nearly 1 in the red. So this performance of the broader markets, the little bit of a risk on that we are seeing, is going to be taken with both hands. There is support coming in from the Asian market. So Hang Seng is up close to about 2%. You've got the Japanese markets, Nikkei, up nearly 1%. A couple of the other sectoral movers, you've got metals and autos fighting for the bulls today. The metal and the auto index are up more than 1%. In the auto names, you've got Eicher, Hero, M&M, all firing. But remember, auto went through the last couple of days of underperformance. So there is a rebound you are seeing. And another way to gauge the risk in the market is also the performance of the Adani group stocks. So Adani Enterprises and Adani Ports are at the pole position when it comes to the large caps in the Nifty. So they're doing quite well post the clarification coming in from the management.
Some green on the screen. There are more stocks actually. The good news for the market today is that there's a mid-cap rebound.
Yeah.
But before we talk about stocks, and I know Pavitra has been looking at some of the interesting trends as well, I think we have the management of South Indian Bank that's joining in. Now, the South Indian Bank is one stock that's not participating in the mid-cap up move. The stock has been down almost 13 to 14% since the morning. And that is when South Indian Bank actually informed to the stock exchanges that Mr. Murali Ramakrishnan, MD and CEO of the bank, has made a request not to offer himself for a reappointment. And that suddenly got the market nervous. I think we have the man of the moment himself, Mr. Ramakrishnan, I think is on the line. Let's see if we can go across to him now. Yeah, Mr. Ramakrishnan, good morning and thanks for taking this call, sir. So obviously the market has gotten very rattled because it didn't see this coming. Let me start with first things first. What is the reason why you are not looking at a reappointment? Would you be completing the entire term? What's the transition? And I think that more importantly, the market will wonder what the continuity plan is going to be from here on.
Thank you so much for the opportunity. Just to clarify, my term actually ends in September 2023. So I'll be completing working till my full term, and I'm not seeking for reappointment for the next term. So we still have 6 more months, and I'll continue to carry out the initiatives which has been taken over the last last couple of years, and we will take it to the next level. So therefore, just to clarify, I'm not quitting. I'm actually completing my term and not seeking reappointment for the next term. As far as the new incumbent is concerned, that is something which the process is just about to start. So I'll be working very closely with NRC in choosing the next candidate, who will be obviously I'll have some overlap in terms of working closely with a new person, to ensure that the initiatives and whatever changes which have been brought about are continuing to be happening in the bank, and we'll ensure that the whatever we set out to do, we indeed make progress in all those parameters and ensure that the bank is put.
But sir, your decision to not seek a reappointment after your term ends in September, is that purely a personal decision, or is there any professional element to it as well?
Absolutely no professional element. I mean, it's purely personal. I just wanted to go and spend time with family. The board has been extremely supportive, and obviously the kind of changes which I've been able to make with the in the organization is with the complete support of board and complete support of the entire employee workers. So there is zilch issue in terms of anything professionally. It's purely professional, personal. Sorry.
Okay. Sir, you're a part of the NRC, the Nomination and Remuneration Committee. Can you tell us if you've identified any potential candidates for the CEO MD role, and what, according to you, is the appropriate overlap to ensure a smooth transition? When do you think you will be able to appoint a new leader at the top?
See, we have just started the process. In fact, the announcement was made yesterday, and we have just appointed an agency to start the process. So clearly, the idea is to ensure that the competent person is selected, and he or she has to have some overlap so that the transition happens very smoothly. The endeavor is to ensure that all the initiatives taken are smoothly transitioned and the new person takes complete charge of taking it to the next level. If you ask me what is the ideal overlap period, there is nothing like that. But typically, I think 3 to 4 months is a good enough period for anyone who has got experience of running the bank to really be on top of the changes which are happening and to take it to the next level. So,
Which agency, sir, have you appointed?
Sorry?
Which agency have you appointed to help look for a new candidate?
We have appointed Hunt partners for this.
Hunt
search.
partners. Okay, and external and internal candidates are being evaluated?
Yes, I think they will obviously they will scout for candidates in the market also, and obviously there will be an element of looking internally also if people can be looked at for holding this job. And I'll be closely involved in the process with the support of NRC. So it will be a process which is just come in. So clearly it's too early for me to even share anything because it just started yesterday. So you can. That too late evening. So you can imagine there's nothing which I can share as of now. If you ask me whether it makes sense to look at internal and external candidates, obviously the answer is yes. And we will obviously look for people who have got experience of handling complexity because as banking scenario is going through a bit of challenges, etc. Clearly a person who has to take it to the next level must have had the experience of handling such complexities. So these are some of the things which are obviously very basic for choosing the right candidate.
All right, very, very early stages of trying to find the next candidate. Mr. Ramakrishna, thanks a lot for joining us. This is Pavitra. Just one question. While I know that it's very early, you just started yesterday, like you were pointing out, is there any kind of broad timeline that you're working with by when you would like to finalize a candidate? Because like you said, there are 6 months left. You do want to ensure that smooth transition. Is there any kind of timeline that you have in mind by when you would like to have a candidate in place?
Yeah, ideally we would ideally it makes sense to have at least 3 to 4 months of overlap. So if we start the process, my guess is that it will take at least a month and a half to choose the right candidate. And also that anyone who we choose, in case we choose people from market, they will have their own requirements in terms of if they are working with somebody, obviously there will be notice period, there will be a gardening period, all that will be there. So frankly, it's too early to speculate as to when the person would be able to join. But given a choice, obviously we would want to have the person as early as possible. The more the overlap, better for the institution because then we can actually take the person also through some of the big initiatives which I am doing currently. There are changes which are being done even now as I am talking to you. And I'll obviously continue to put everything which we have initiated to be in place by September before I before I leave the organization. So the earliest the person comes, better for the organization. Yes, obviously 3 to 4 months will be a good enough period for a seasoned professional to take it forward.
So as the bank goes through this management transition, Mr. Ramakrishnan, let me ask you what your priorities will be over the next 2 quarters as you sort of, make your way out, as well as your advice and I think the strategy for the new person who will come in. I was looking at the third quarter performance. I mean, loan growth was not a problem at all. You were touching almost 20% loan growth. NPAs were falling, but one can argue still at about 5.5%. They were slightly high. And I think deposit mobilization is something that, the entire system, a lot of the mid-level banks are really struggling with that. And we saw some element of that in the third quarter numbers. So again, just to go back to my question, next 2 quarters, what is the task you set out for yourself, as well as the handover that you'll give to the new person coming in?
See, the focus for the next quarters will be continuation of what I have been articulating in my strategy document. See, if you recall, we made a strategy document which was supposed to be till March 24. And due to COVID, etc., we extended some of the parameters to be reached by March 25. So if you recall, there were 2 pressing issues when I took charge. One was capital adequacy, the other one was PCR. Now, both are obviously, we are now much better off than what we started with. Our capital adequacy is comfortable at 16.25. Our PCR is fairly decent now. Excluding write-off, we are at about 62%. So the endeavor is to obviously take them to the first milestone of reaching 70% excluding write-off, and including write-off, we would want to be at least 75% plus. NPA levels, clearly the endeavor is to bring it down below 2% net NPA level. And we would also want to continue to grow our NIM. The target is to reach 3.5%. I had given a guideline of reaching 3.2% by March, and we are well on track to reach that. And asset growth for the coming year, we are sort of estimating that we would want to grow at least 2 times what a GDP growth would be. If you go by the estimates, it will be anywhere from 6 to 6.5% is what we are anticipating. So 12 to 13% kind of growth is what we will definitely plan for the coming year in terms of asset growth. As far as liability is concerned, I just want to make a small correction. We actually consciously took a decision not to go for bulk deposits. So I've been in the process of granularizing my deposit right from the time I took charge. So if you look at my retail deposit growth, it's been happening quite well, and it is in tune with what market has been growing. It's only because of our stated strategy to granularize our deposit that you are seeing the overall deposit growth being lower than what market is doing. So if you factor retail alone, we are fairly comfortable. And of course, with the repo rates going up over the last 6 quarters, clearly there is a upward revision of 2.5% in terms of repo rate. So we have been continuously repricing both our liabilities and assets to ensure that our NIM continues to be taken care, and we are obviously ensuring that our deposit holders are in the money and they are continuing to make good income. So that's a continuous...
Mr. Ramakrishnan, sorry, I'm just going to clarify the number. You mentioned 2% NPA. You're talking about at the net level, and by when do you see yourself going to 2% NPA?
Next two quarters.
Next 2 quarters. And NIM, if I heard you correctly, I think you said 3.4%, but that's a March...
3.5% for next March and 3.2% for this March, for this month end.
3.2% for this March. And finally, just leave us with an outlook on loan growth as well. Is it as robust as what we saw in the 3rd quarter? How do you see the next 2 quarters shape up?
No, actually, if you see in the market, there has been a bit of slowdown in the asset growth also from October onwards. If you when the liquidity situation started becoming tight, etc., asset growth has been coming down a little bit compared to the past. The guidance which I gave was 12 to 13% kind of growth in asset also for the year ending March 23. I think we will probably be reaching that kind of level. Obviously, it won't be as good as 18-19% which we were seeing in the first 2 quarters. Obviously, our base was also quite low. Since the entire transition in the last year, our base was quite low. We actually started growing quite well from the December of last year to the March of last year. So the huge growth started happening after my restructuring of the asset and liability. We witnessed that from December of 21 till March 22. Therefore, the base was quite high for the 4th quarter. Considering that base, I am sticking to my guidance of 12 to 13% kind of growth for the full year, for this year ending March.
12 to 14%. Thank you very much, Mr. Ramakrishnan, for joining in. We look forward to hearing more from South Indian Bank about the next CEO MD appointment and chatting with you before you, hang your boots. Thank you very much for joining in. By the way, for the markets, there's been a sudden sharp fall. The Nifty was holding above 17,000, and suddenly, in a matter of minutes, it's given up close to about 50 points. There you have it. ITC is now down close to about 0.5%. Heavyweights like HDFC Limited, HDFC Bank have seen a sudden collapse in the stock price. Infosys has moved to the low point of the day. Nestle, UPL, that's a stock which was under pressure. Some of the reversing some of the outperformance from yesterday, but now it's again taken a bit of a step down. As we speak, SBI Life too has now given up all its morning gains. So getting a bit choppy for our markets. Remember, today is the March expiry. Get into a break. On the other side, we'll talk real estate. Abhishek Kapoor of Purvankara and Anuj Puri of Anarok will be joining in to discuss the trends in the Indian housing market.
Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC-TV18. The market has seen a slip like we were pointing out. It is a lot of the IT names. In fact, the IT and FMCG index are now in the red as well. A lot of the large cap IT names at the low point of the day. So you have Infosys, you have something like a Wipro, Tech Mahindra, all of these which have slipped to the low point. So keep your eye out on this entire space. And also some from the consumption pack. So the likes of Nestle, ITC seeing some cuts. That's what's going on with the market. But let's talk about the world of commodities now. now Manisha joins us, and today she's talking about crude, where there's actually been some gain.
It has been, yes. It's trading at a 2-week highs right now, and the crude oil prices have gained up by more than 4% in this week. When you look at the crude prices from its lows, that is when the banking crisis happened, we did see the prices decline from $88 to $70, and we are back at around $80 a barrel right now. So it has been a volatile move. But the latest trigger in sense of support comes in from the U.S. inventories, where there is an expected decline of 6 million barrels in the previous week itself. Yesterday, the prices gained because the export of nearly 400,000 barrels per day from Turkey seems to have halted. So there are supply concerns here. And then the markets are looking at nuclear statements from the Russian president. So the geopolitical premium also is coming into the markets. And the Russian oil minister says that the friendly countries have seen strong imports continuing from Russia, that is China and India, where we are looking at imports, especially in India, increased by 20-fold as compared to the previous year. The support also comes in from the Chinese demand, which is expected 6.5% higher on a year-on-year basis for the year 2023. And also with the banking sector concerns easing, a decline in US dollar index, buying in other risky assets, also buying in equity markets, that seems to be supporting the crude prices also. So not just the WTI and Brent, but the Russian Urals, which were trading at around 2-year lows below $50 per barrel, also have seen some support come into the markets as of now.
Okay, thank you very much for that. Let's now turn our attention to the real estate and housing space. Despite a global economic headwinds, there have been layoffs by several large and small corporates. The Indian housing market continues to remain very resilient. Quarterly housing data shows that in Q1 of this calendar year, Jan to March period, the housing sales are at a record high level, at least compared to the last decade, with more than 1 lakh units sold across the top 7 cities. This is the research coming out of Anarock. So talk more about the trends. We're joined by Abhishek Kapoor, CEO of Puravankara, and Anuj Puri, the chairman of Anarock Property Consultants, on the show. Gentlemen, thank you very much for joining in. Mr. Puri, if I may start with you, can you give us details about what has happened in the current quarter, Q1, across geographies, across segments?
You're absolutely right, is that it has been a stunning quarter of this calendar year, the Q1. You know, it is never in the last 10 years, we've seen 1.14 lakh units of residential being sold in just one quarter. 2022, we thought was a record quarter when about 99,000 units were sold in that quarter. But this quarter has done exceptionally well. Bombay and Pune are 50% of the market. The rest of the cities are the balance 50%. But what is interesting is that when you actually start to peel the onion, the affordable housing sale has gone down and the mid segment to premium has really picked up. The luxury, on the other hand, both in Bombay and Delhi, has done an exceptional number. On the other side, if you were to look at the launches, so this was on the sale side, launches also, we have seen record number of launches that have been done. Again, over 100,000 units that were launched for the Q1 of this calendar year. And again, 50% of that is coming in from Bombay and Pune.
All right, that point is taken. And, especially the part where you're talking about how luxury sales are doing very well. Perhaps the mid segment is not doing as well. We had that viral picture of DLF where flats over 7 crores are just, flying off the shelves. Mr. Kapoor, if I can come to you first, since, we are talking about how maybe the mid segment is not doing quite as well. Can you take us through what demand is looking like overall? And you also had the recent Purva Oakshire project. I believe that one has done really well, and, with sales of over 100 crores over there as well. So if you can just take us through a little bit of what demand is looking like and what you're expecting in terms of sales value.
I quite agree with what Anuj said. If you look at our Provident Housing and Puravankara sales, the numbers have been quite staggering even for us. Last quarter normally is the best quarter of the year across the sector, being end of the financial year as well. So in the same direction, I think the business has done very well. And you were right, Oakshire is a plotted development, which we recently launched. It's a little over 30-acre plotted development. And on the first weekend, we had more than 100 crores of sales. I guess we will be sold out very shortly. So it's done very, very well for us. As a trend, what we are seeing is both sustenance and new launches have continued to see significant traction, though most of our launches have been in the southern markets, all in Bangalore and in Chennai. largely. But all of these projects have done quite well, including sustenance and new launches. And we're seeing that strong demand continuing as of now.
So do you have any kind of estimates of, what you're expecting in terms of sales value for the next year, for, for the coming year, that is, for FY24, if you can take us through that?
Look, I can't give you a guidance number, as you know, but what I can share with you is that we will be adding another total of 14 million square foot of new launches in the next financial year. We've already added about 6 million in the last financial year, including the 2 million in this quarter. And you would typically see that when you add this kind of volumes, given the fact that today the demand-supply gap is absolutely there, we are down to less than a year's inventory across the board, across the country. In terms of sales, we expect that these new launches will continue to support our growth in terms of sales number in the next year as well.
Okay, interesting. So just to press that point further, what is, Abhishek, the growth divergence, if any, between your luxury segment and between the mid-level? Because the one concern that obviously does around pretty common sense one is that there's some sentimental shift happening now, particularly in the IT sector, a little more sort of concern given everything that's happening in the US market, for instance. So is there any risk to the growth prospects for the mid-income segment? Just give us the growth rates between luxury and the middle.
See, I'll share with you that we have not seen much of a difference in terms of absorption or demand for our mid segment, which is Provident Housing. All of these projects have continued to see buoyant demand. In fact, sustenance numbers have been quite well. And a large amount of new launches we are doing next year are in the same segment. And see, if you look at, what's happening in the marketplace is the consolidation is still playing out. There is still a journey to go as far as consolidation is concerned. And I believe that the organized branded players will continue to gain market share. And hence, we see that this market will continue to do very well. What you will also see is that below 35 lakhs, which is not a part of our portfolio though, which is really the affordable housing category, is actually what is suffering the most in the marketplace. And, I quite subscribe to that supply and demand will continue to suffer for some time.
Well, as they say, right, there is never a recession with the rich. So the premium luxury segment continues to do well, even if the interest rates have started biting the lower end of the economy and hurting the lower end of the segment sales. But Mr. Puri, there is a possibility of a stamp duty hike in Maharashtra. Have you heard any chatter on that front, and will it hurt demand?
So I haven't heard any chatter, and I hope it doesn't happen. If it does happen, certainly it will impact the demand. Clearly we had seen when the stamp duty had gone down during the COVID, there was a huge rush of sales, and the activity had brought in more revenue to the exchequer by having reduced the stamp duty. So I hope that they don't go ahead and increase the stamp duty from where it is today. But I do want to subscribe to one point which Abhishek said is, and I think you're going to see more and more of this coming out, is that, in the consolidation phase, the good quality developers, the reputed developers, both listed and unlisted leading developers will take in more and more market share. And the data that is showing to us is that, 4 or 5 years ago, their share of the total sale was 17%. And today that has escalated to 30%. So, clearly they are benefiting not only from the growth in the market, but also from consolidation by eating somebody else's lunch.
Anuj, hi. So, running a little short on time because of some breaking news on the show. But, put it in context for us. Over the next 12 months, as the economy undergoes uncertainty in India and around the world, A, do you think real estate will keep showing the kind of smart, strong growth rates that we've seen? And B, which do you think will be the hottest markets in terms of pricing? Give us a sense of pricing. I mean, pre-COVID till now, where has the appreciation been the highest? And which pockets do you expect will see more price hikes?
So clearly it is Navi Mumbai that we're starting to see a huge amount of price appreciation. And this is largely led by the infrastructure, the new airport that is coming up. A lot of the people have started to move towards the Navi Mumbai belt, Panvel belt. where the new airport is likely to come in at the end of next year. So that bet has done well. Bangalore continues to surprise us. It is a very strong market, despite the news that we're getting on the IT world and job cuts. The sales in Bangalore continues to remain very strong. NCR, Gurgaon, I would pick up as a market, not necessarily Noida. So those are three markets, Navi Mumbai, Bangalore, and Gurgaon. Pune has consistently, right through the COVID and post-COVID, continues to do exceptionally well. So those would be the markets that I'll pick up. Going forward, next 12 months, I do feel some challenge will come in because, with the mortgage rates continuing to go up, and if the global, economy goes into a recession, India is not going to be insulated. We will see some tremors come up here as well. So there is a possibility that we may see some negative impact come on the housing sector. But perhaps that is largely going to be in the affordable and not in the premium luxury or the mid-level segment.
All right, we take that point and we will have to leave it at that. Gentlemen, thank you both very much for joining us and taking us through this chat on how real estate demand is really looking, where you're seeing a bulk of it come through and how it could move. And I think the view is pretty much, standard across the board that the luxury segment continues to do very well. While maybe there's a little bit of pressure that is coming through in the mid segment, which could, of course, get enhanced if we do see this recession that we've been talking about. We do need to get into a short break in the show, but when we come back, we're going to talk about the market. We'll have Mitesh Thakkar on the technicals. Welcome back. You're still tuned into Trading Hour. For the market, we're looking at a 25-point gain right now. So we've definitely come off the highs. The Nifty mid-cap and small-cap index is holding well today. That is, the key positive that we're looking at right now. Quite a reversal from what we've been seeing over the last 2 days. So we're seeing the mid-cap index trade with a gain of around 0.8%. That is the good part. And the Nifty Bank also holding up quite well right now, around 220 points higher. Let's get you a technical check on the market. Mitesh joins us now. Mitesh, it is the FNO expiry day. We have come off the highs once again below that 17,000 mark. How do you look at this now, considering that it is expiry today? We have a holiday tomorrow as well.
Yeah. So I think the expiry factor does affect the market, on an intraday basis, but the overall trend still remains sideways. We've been advocating that the market may not do much, and we might actually be basically chopping around within this range of 16,850 to about 17,150, give and take 20-30 points on either side. So I think that view still remains. The overall possibility, I still believe that is more biased towards an eventual breakdown. But I think till that happens, the market might just next few days still be sideways, given the fact that the volatility indicators are turning flat. So not much of juice trading in the call. Shriram finance is something which is giving you. So keep a stop here below 1230. Go long for targets of around 1280. And Tata Chemicals, that's on the sell side. Keep a stop above levels of 958, 959, and look for targets from 925.
Okay, got that, Mitesh. Thanks very much for joining in with that quick update on the market. A market that seems to be changing color and contour rather quickly. Remember, today is also the monthly expiry. And perhaps we're getting some of that volatility, a bit of short covering, and then the moment you get a rise, that gets sold into. So that continues, and that sort of texture of the market hasn't changed, and we're trading just, now actually not just, fairly below the 17,000 level. Well, we'll take a quick break on that note. On the other side, we will discuss market fundamentals. Vikas Khemani of Carnelian Capital Advisors with us, along with the views from the street.
Welcome back. You're tuned into Trading Hour, and let's get a conversation going on where the markets could really be headed. We have Vikas Khemani joining us. He's founder at Carnelian Capital Advisors. Vikas, thanks a lot for taking out the time to speak with us today. This is Pavitra. It's really beginning to feel like that market which is just dragging, right? And we've been talking about how the pain in the broader markets is even more than what's perhaps evident on the frontline index. Can you tell us, in a market like this, are there still pockets where you feel you're comfortable putting fresh money to play?
Hi, Pavitra. I think, whatever we are seeing in Indian markets are, of course, the result of what's happening globally, especially in the SVB and Credit Suisse crisis, and that had an impact. And these are the very large events at the global level. So, of course, right now, a bit of a risk-averse environment is there. But as far as India is concerned, while could be some slowdown in growth of some sectors from short-term perspective, we think that these are the times when there's a lot of uncertainty, a lot of worry in the market, are the times to deploy capital, because that is where you get same companies which were available at 30-40% higher price only 2 quarters ago or a couple of months ago. So if you believe in the long-term fundamentals of any company and long-term opportunity, I think you've seen sizable valuation correction across the board. So we are finding lots of interesting names and opportunities, and we are deploying capital on a regular basis in these kind of markets.
Vikas, hi, good morning. A slightly different question. You interact with HNIs at a regular basis, and people basically who've got the money, right? What are they thinking? And more importantly, what are they doing? Because so much is changing. The equity market hasn't been easy last 12, 13 months. And then you have these major tax changes happening on the mutual fund side. Plus, yields are still attractive at 7% plus if you're looking at other instruments. So is the equity market, at least in the last couple of days, is it also suffering because of some of this money moving around?
These are very substantial changes which have happened, especially where a lot of HNI money was deployed. So, of course, some amount of shifting possibilities happening, fixed income attractiveness has gone up, and hence some people have moved towards that. That's all real, right? And especially also one thing is there, the human mind always sees more risk. If there's a risk in the recent past and if there's a return, then you see more return in the same way. So last 1.5 years, money has not been made. So people are thinking that, oh my God, we thought India is great and still money has not been made. But what we don't see is the context and environment where, once in a 40-year kind of things which have happened, interest rates have risen so sharply in a shortest period of time. And despite India's holding on, it's a great outcome according to me. In equity always delivers returns in step function. It is never linear. So, right now, it is no doubt that the people who are deploying capital, but the proportion of that is reduced. I guess till the time worry or fear settles down, you might see still remaining tepid, but it's, in my opinion, 3-4 months away. Market might go through side corrections, but money would come in, I have no doubt in my mind.
Exactly on that. Let me ask you a follow-up. Now, could the converse become true? I'm just trying to be an optimist here. Now, you can't invest in MLDs. They're no longer tax efficient from the 1st of April. You can't invest in debt mutual funds because they don't have the tax advantage. So can some of that money start moving back to equities? I'm just taking a reverse argument, trying to be optimistic on the equity side.
Yeah, I think everybody works based on the asset allocation. Of course, net returns post-tax has some impact on, allocation at the edge. But let's say, hypothetically speaking, based on your risk statement or your return statement or your policy statement, if your debt equity allocation is 50-50, let's say, because of tax, you are not going to make 100-0. You might make 55-45. So 5-10% plus minus here and there can happen. My fundamental belief is that, over the years, that is the guiding factor, and that allocation will remain irrespective of what the returns are. There was a time when fixed income return went down as low as 3-4% post tax and 5%, and still debt allocation was very large. So that doesn't change much, in my opinion. And equity, we have known that over a 20-year period has given 17-18% IRR. So equity is a very different, non-linear equity return asset class, and most people understand that, and hence I don't see a major shift on that.
All right, don't see a major shift on account of this. Vikas, short chat today, but we're going to have to leave it at that. Hopefully, we will be able to talk to you soon in the coming few days on where you see the markets really headed. Thanks for joining us today. We do need to get into a break, but on the other side, there's lots more market action lined up. We'll also tell you about a new possible IPO on the street. Stay tuned.
Welcome back. Just turning our attention away from the secondary markets to the primary markets. There is going to be a new kid on the block. a company called NetWeb, which is into high-end computing solutions, has filed its DRHP with SEBI for an IPO. Now, this is a company which makes high-performance computing systems. They also provide private cloud, hyper-converged infrastructure, AI, enterprise workstations, data centers, etc. So this is the space that the company operates in. As I said, they filed this DRHP with the SEBI. They intend to raise 257 crores via a fresh issue, and there is also an offer for sale by the promoters, where the promoters are looking to sell about 8.5 million shares. Bulk of the money raised will be used for funding the company's long-term working capital requirements. They have some capex plans, and about 128 crores will go towards that. But this is a small company. It's a completely made in India company. It's participated in the PLI scheme of the government. But in terms of revenues, last year, the revenues were about 250 crore, and in the first 6 months, the company's revenues have been about 143 crore. And the bottom line, as you would see, roughly the PAT percentage is about 8 to 10 odd percent. The risk associated with the company, one, of course, remember, it's a smallish company, but more than 50% of its revenues comes in from the government. So they are dependent on the Indian government for their tenders, and these tenders are competitively participated in. And just take a look at the order book. The order book has actually, come down in the last 6 months and now sub 100, crore rupees. Maybe the company has executed more in the last 6 months, but just want to point out these numbers. It's a small company, but it operates in a niche segment, high-end computing systems, and they're trying to make their way to Dalal Street now.
All right, Rima, thanks a lot for filling us in with all of the details there. With that, we need to get into a break on the show. But on the other side, we're going to talk all about AT1 bonds in our special segment, Fin Street. So stay tuned for that.
Welcome back. You're with us on Trading Hour, and we'll move to our special segment, Fin Street now. Abhishek is standing by with a breakdown on AT1 bonds, which came to earn a bit of a bad name after the Yes Bank fiasco.
Well, additional Tier 1 bonds have been in focus with the recent issues seen with Credit Suisse, and also in India it has been in focus ever since Yes Bank got regulatory approval to write them down. So let's understand what is additional Tier 1 bonds and its importance in capitalization of financial services entities in India. Under the Basel III framework, banks' regulatory capital is divided into Tier 1 capital and Tier 2 capital. So Tier 1 capital is subdivided into common equity capital, that is CET1, and additional Tier 1 capital, that is AT1. So equity capital is classified as CET1 ratio. Perpetual bonds that satisfy specific conditions stipulated by RBI are classified as AT1 bonds. So additional Tier 1 bonds are unsecured bonds with no predetermined maturity date. It forms part of lender's core capital, or commonly known as the Tier 1 capital. Now, AT1 bonds clubbed under perpetual bonds do offer a call option, that is, lenders can repurchase them from investors. Besides, if bank face bankruptcy or run short of capital, they can dismiss the principal amount and not pay any interest. The interest payable to the investors may be either at a fixed rate or at a floating rate. Earlier, the spreads between AT1 bonds and NCD coupon was around 100 basis points, which made people put in money into AT1 bonds of banks. Issuing banks have the option, subject to conditions stipulated by RBI being satisfied, to recall the AT1 bonds issued by them. However, while the banks are not compulsorily mandated to exercise such call option and have a discretion whether to redeem AT1s or not, the tacit understanding with investors is that the indicated call option will be exercised as scheduled. However, today, the spread between AT1 bond versus the yield in NCDs have narrowed down to, about 20-30 basis point only. While earlier, investors had the perception of earning more from AT1 bonds, post Yes Bank case, most investors prefer safer debt instruments. The majority of the investments since the inception of AT1 bonds have been made by big corporates, mutual funds, entities, as well as HNIs or high net worth individuals, etc. The loss absorption through the conversion or write-down of AT1 bonds instruments is triggered when the CET falls below a predetermined threshold of risk-weighted asset, like it did for Yes Bank. AT1 bonds are regulated by RBI in India. Out of 36 lenders, 20 have no AT1 bonds in their capitalization, the likes of Yes Bank, Karur Vysya Bank, Federal Bank, City Union Bank and Bandhan Bank. 7 lenders have AT1 bond ratio between 0% to 1%, like Kotak Mahindra Bank, HDFC Bank and ICICI Bank, while 9 banks, largely PSU banks, have AT1 capital of more than 1%, the likes of Canara Bank, Bank of Baroda and SBI. Now, AT1 bonds can be from domestic as well as from foreign markets. So, banks with foreign business or presence of business in foreign locations have a part of their AT1 capitalization coming in from foreign market.
Abhishek, very interesting there. Thank you very much for explaining that. With that, it's a wrap on Trading Hour from the entire team. Thank you for watching.